Imagine spotting a market reversal before the trend changes. A pattern so powerful, traders have used it for decades to identify major tops and bottoms in the market. And the best part, once you understand the psychology behind it, you will start seeing it everywhere. Today, we are breaking down one of the most famous chart patterns in technical analysis, the head and shoulder pattern. In this video, you will learn what the head and shoulder pattern actually is, why it forms, how professional traders identify it, how to trade it step by step, common mistakes traders make, and whether this pattern is truly reliable or not. So let's begin. What exactly is a head and shoulder pattern? So the head and shoulder pattern is a reversal chart pattern. It usually appears after a strong uptrend and signals that buyers may be losing control. It consists of a left shoulder, a higher peak called the head, and another similar peak called the right shoulder. These three peaks form around an important support area called the neckline. When the price breaks down below this neckline, the market often enters a bearish phase. The left shoulder forms a strong bullish move. Buyers push price higher, but profit booking starts. This creates this first pullback. At this stage, bulls are still in control. Second part, the head. Price then rallies again and creates a higher high. This forms the head, but after making the new high, selling pressure becomes stronger. Smart money may start exiting positions here. Momentum is still bullish, but cracks begin to appear. The third part, the right shoulder. Now buyers try one more time, but this time price falls to create a new high. This weakness forms the right shoulder. This is where bullish momentum weakens significantly and sellers slowly begin taking control. The fourth and the important part, the neckline. The neckline connects the swing lows between the shoulder and the head. It acts as a critical support, and when the price breaks below the neckline, that's when confirmation usually comes. Is head and shoulder bullish or a bearish pattern? So the standard head and shoulder pattern is considered a bearish, but it signals a possible reversal from an uptrend to a downtrend. But there's also an inverse head and shoulder pattern, which is bullish and forms after a downtrend. We'll discuss that both later in the video as well. More importantly, how to identify head and shoulders accurately. To identify the patterns properly, look for these conditions. Those are a clear prior uptrend, three peaks, middle peak being the highest, right shoulder lower than the head, a visible neckline, volume generally reducing during formation, and the most important thing is the structure. Don't force pattern where they don't actually exist. How do you confirm the head and shoulder pattern? A head and shoulder pattern is usually confirmed only after price closes below the neckline. Many beginners enter too early before confirmation. That increases the chances of false signals. Professional traders often wait for neckline breakdown, volume confirmation, or even a retest of the neckline. The important question sometimes comes like the neckline, does it need to be horizontal? So it's a no. The neckline can be horizontal, sloping upward or sloping downwards. But generally, a downward sloping neckline is considered more bearish and an upward neckline may indicate weak bearish momentum. So what does exactly happen when the price breaks the neckline? When the neckline breaks, it signals that sellers have gained control. That breakdown often leads to trend reversals, long unwinding, increased volatility, and fresh short selling as well. Sometimes price retests the neckline before continuing lower. People often have this question that can the shoulders be uneven? The answer to that is yes. The shoulders do not need to be perfectly symmetrical. In real markets, patterns are rarely perfect. What matters most is the overall structure, trend context, and the neckline confirmation. Let's have a look at the different types of head and shoulder patterns. The first one is going to be the standard head and shoulder, that is classic bearish reversal after an uptrend. The second one is inverse head and shoulders, that has a bullish reversal pattern after a downtrend and a structure that is flipped upside down. The third one is going to be the complex head and shoulder pattern. This includes multiple shoulders, extended consolidation, or irregular formations as well. These are a bit harder to trade as well. So the fourth one is going to be failed head and shoulders. Yes, that is also a pattern. Weird, right? But it is. Sometimes price breaks the neckline but quickly reverses. This is called a failed pattern, and failed breakdowns can lead to sharp moves in the opposite direction as well. So now the important question, how to trade head and shoulders? Let's have a look at it step by step. The step one would be identify proper uptrend. The pattern works best after a strong bullish trend. The step 2 is going to be mark the structure and identify the left shoulder, the right shoulder, and the head as well. Step 3 is going to be draw a neckline. Connect the swing lows together. Step 4 is going to be wait for the breakdowns. Don't predict. Wait for the price to close below the neckline. Step 5 is going to be the entry. You can enter aggressively on a downward or wait for retest confirmation as well. Step 6 is going to be the stop loss, which is also one of the important parts. Place the stop loss above the right shoulder. That invalidates the bearish setup. The final step is going to be step 7 to choose the target. Use the measured move method. Measure the distance from head to the neckline, then project the same difference downwards as well. So how reliable is this pattern exactly? Our backtesting results with the head and shoulder strategy tells us that both the top, the bearish reversal, and the bottom, inverse head and shoulder, the bullish reversal, has been regarded the most reliable chart reversal pattern since Edward and Maggie published technical analysis of the stock trends in 1948. Thomas Bullock's Encyclopedia of Chart Patterns, second edition of 2005, documented a 93% success rate for the head and shoulder tops and 83% for inverse head and shoulder bottoms across 38,500 occurrences updated 2021 to 2023. Research by Bulwoksky's tracking post-2008 market regimes revised the failure rate to approximately 7% for tops, still exceptionally very low, reflecting the greater algorithm participation in modern markets. There are a few common mistakes that you can avoid while using the head and shoulders pattern as well. The first one is entering before neckline breaks, which can lead to premature entries, increasing false signals as well. The second one is forcing patterns. Not every three-peak structure is a head and shoulder. Yes. The third one is ignoring the volume. So volume confirmation is extremely important in the case of head and shoulder, really important. The fourth one is misplacing the neckline as well. A wrong neckline changes the entire setup altogether. The fifth one is ignoring broader trend. Always analyze the overall market context first before using the head and shoulder pattern. The sixth one is no stop loss, which can lead to a lot of losses. So risk management is non-negotiable while using this particular tool. Seventh one is confusing the inverse versus the standard. One is bullish and one is bearish. Do not forget that. Now let's have a look at some of the benefits and limitations of the head and shoulders pattern as well. So the benefits are easy to identify, clear entry and stop loss, strong reversal indication, works across markets. There are a few limitations as well, which can be false breakouts, subjective interpretation, and which can lead to fail in strong trends and not always symmetrical ones. Now let's understand what does exactly happen when the head and shoulder patterns fails. When a bearish head and shoulder fails, short sellers may get trapped. That can trigger a short covering rally. Failed patterns often create explosive moves. Now let's go towards the best indicators that you can pair with head and shoulders. Some useful indicators that you can include are volume, RSI, MACD, moving average, and ADX. For example, if RSI shows a bearish divergence during the head formation, the pattern becomes more stronger. Head and shoulders versus the double top. If you talk about head and shoulders versus the double top, head and shoulder is often considered stronger than the double top because it shows failed continuation, lower momentum, and gradual buyer exhaustion as well. A double top is simpler but sometimes less reliable. Triple top versus the head and shoulders. In triple top, all peaks are nearly equal, but in head and shoulder, the middle peak, the head, is clearly higher. The difference reflects changing market psychology clearly. So should traders use the head and shoulder pattern? Yes, but not blindly. It works best when combined with volume, trend analysis, risk management, and confirmation. Always remember that the pattern itself is not magic. The real edge comes from understanding the psychology behind the price action, which is very important. What's your favorite chart pattern in the technical analysis? Comment below. And if you want more videos on professional trading concepts explained simply, make sure to hit the like button, subscribe, and follow for more. Thank you.